Hello everyone and welcome back to the podcast. Today I'm going to be explaining in depth why I believe HIMSS has 100x potential over the long term. This episode may be worthwhile listening because in the recent past I've gotten a number of picks right. One of them is Palantir, that investment is up over 6x. Spotify, that investment is up over 5x. In the past I invested in AMD, that's up over 40x right now. Tesla, my pick is up over 14x. Of course I get some wrong and I've written about that in depth in my blog. But I feel like HIMSS is going to be a huge success. So long story cut short, I believe HIMSS has 100x potential over the long term because it's running the same operational algorithm as Amazon or Costco. Although the operational algorithms of the two differ slightly, they have some characteristics in common, which HIMSS has too. And because HIMSS is executing so well, I believe that this company has a long runway ahead. So let's get deep into it. The world's top companies follow a blueprint. They essentially solve a growing volume of acute customer pains in a way that eventually is impossible to imitate profitably. This equation elegantly summarizes Amazon and Costco's respective 209,000% and 18,858% since IPO. This is also true of companies like AMD and Tesla that have multiplied my original capital invested by 40x and 14x respectively. And last but not least, this is also true of my recent Palantir and Spotify investments. The aforementioned blueprint cannot encapsulate all possible forms of corporate success, but it does reveal the causal mechanism behind a sufficient volume of success stories for it to be useful when it comes to spotting new winners in the wild. In turn, it so happens that HIMSS is a near perfect encapsulation of this thesis, with core value drivers accelerating quarter over quarter. Indeed, talking about a 100x potential over the long term seems far-fetched to many, but it's the sort of return you get over the long term when you jump into one of these quote-unquote blueprint machines early on, before anyone else. In order to satisfy the blueprint's equation, a company ultimately needs to create a platform from which it can launch new products and services at a marginal cost. In turn, the capital these new products and services yields needs to then be reinvested in order to then lower prices for customers and still produce higher volumes of capital. This pattern of reinvesting capital to make prices lower for end consumers was first coined by an investor called Nick Sleep, and he termed it as sharing economies of scale. Essentially, by sharing economies of scale over a long period of time, a company makes it almost impossible eventually to imitate what it does profitably because it makes prices so low, and that's what makes it so hard to compete with the company in question. This is exactly what has happened over the past few decades with companies like Amazon, Costco. It's now happening with Tesla, it's happening with Spotify, it's happening with Palantir as it productizes its offerings too, and this is one of the most powerful forces in capitalism. This blueprint is thus a particularly useful model for the age of platforms in which we find ourselves in. And what's surprising is how the blueprint plays out time and time again in front of the market size, and yet the market fails to recognize this blueprint time and time again. Indeed, the market oscillates from seeing HIMSS as a Viagra dispenser to an opportunistic GLP-1 knockoff dispenser. But the market fails to understand that HIMSS is actually building a platform which will enable the company to launch new healthcare verticals over time at a marginal cost. Meanwhile, as you can see in the graph below, HIMSS's capital expenditures have been trending up as the company has been making more money. Simultaneously, as I first spotted in my Q4 2023 HIMSS Earnings Digest, HIMSS is actively reducing prices for customers that opt into longer duration treatments. In Q4 2023, the gross margin ticked up from 82.62% to 82.74% quarter over quarter, so that is from Q3 to Q4 2023, despite the price reductions, which is finally what enabled me to see that HIMSS is a perfect instance of the blueprint that I'm discussing in this video. Indeed, HIMSS is a fine-tuned machine that shares economies of scale with customers. In the last few quarters, however, the weight loss vertical is gaining traction, and at present, this vertical is dilutive to margins, as is the case with HIMSS's new verticals early on in their journey before the company optimizes them fully. This will make the numbers a little bit blurry over the coming few quarters, but in Q4 2023, the company revealed its genetic composition. Now I know what it's actually made out of. Additionally, as I point out further on in this video, the development of the weight loss vertical points to second level KPIs, which are accelerating rapidly, which mean that the company is going to do much better over the coming year than it has done over the previous year. And this is something that the market is ignoring too. There are many platforms around the world, but what initially caught my eye about HIMSS is how they've overcome a number of statistically highly unlikely challenges sequentially, one after the the other. As I described in my first HIMSS deep dive, the US healthcare market is a monopsony in that there is only one buyer. The only buyer is insurance companies, which means that healthcare providers have the incentive to just jack up prices every year because that gets amortized among the insuree base. There's so many people that are insured that how can a little price hike hurt, and so forth. And that's how the US healthcare system has come to be an inflationary hamster wheel. So the point that I'm trying to get to now is that while some believe that Amazon will kill HIMSS very quickly, the company has in fact succeeded in instantiating the below infrastructure, so the infrastructure that you can see on the screen now, while printing cash from operations and operating outside the traditional insurance system, which basically no one has done successfully to date. Jeff Bezos, Warren Buffett, and someone else that I forgot came together to fix this problem, the whole inflationary dynamic in the US healthcare system, and they had to pull apart the partnership because they couldn't figure it out. This is a total statistical anomaly which points to an either very lucky and or very talented management team, and by extension to a company that has the adequate culture to fix the US healthcare system's major problems. Regardless, my view is that the growing cash from operations that the company is printing quarter over quarter is actually pointing to a moat. Indeed, either the $4 trillion US healthcare market doesn't actually care about HIMSS's revenue and wouldn't like to gobble up that revenue, or it simply is not able to do so at present. The two things cannot be true simultaneously, and to date, what we've seen is much larger players than HIMSS coming into the industry with all the adequate assets and resources like prominent distribution networks and so forth, and fail to gain the traction that HIMSS has gained. This includes Walmart, by the way, which recently had to shut off its telehealth division. Thus, the platform is not only printing increasingly attractive financials, but is also exhibiting early signs of moat formation. Neither Palantir nor Spotify had strong moats by age 7. However, HIMSS is currently defeating much larger players that in theory, as I was saying, have all the necessary assets to disrupt it. What's particularly interesting is that the aforementioned qualitative signal, so Walmart having to shut down its telehealth operation, coincides with HIMSS accelerating the most essential part of its business that the market is absolutely ignoring, which is the time it takes for the company to deploy and mature its new verticals. As has been the case retroactively, therefore, all the qualitative signals are pointing in the right direction. They're all pointing to the fact that HIMSS is an extraordinary organization that fits the blueprint that I mentioned at the start of this video. It simply looks to me like HIMSS is fixing a growing volume of acute customer pains over time and making it increasingly harder for competitors to imitate the operation profitably. As of Q2 2024, HIMSS has managed to deploy and mature the weight loss vertical in 1/3 of the time it has historically taken the company to do so with its other verticals. 7 months into the operation, at the time of the Q2 2024 report, the weight loss vertical had 100,000 customers and an annual revenue run rate of over $100 million. What this means is that HIMSS is now able to launch verticals and mature them much faster than previously, and this actually points to an underlying mechanism that's enabling HIMSS to get faster in this sense. HIMSS is getting faster at deploying and maturing verticals over time. Since free cash flow is largely a function of revenue per user at this point because the platform clearly enables them to launch new verticals at a marginal cost, the quicker development speeds mean we will see free cash flow grow even further, even faster than over the past year, which you can see depicted on the graph below. You can see our free cash flow has been rocketing, especially year over year from Q2 2023 to Q2 2024. Faster deployment, faster maturation of verticals means this graph is probably going to grow exponentially from here. The key underlying enabler of the operation is the fact that HIMSS is selling below copay. So the amount of money that people have to pay in order to access healthcare before the insurance actually covers for their healthcare bills, which by the way, copay is going up year over year due to the monopsony situation in the US healthcare market and just how much of an inflationary hamster wheel it is. And management's ability to pick new healthcare verticals with a positive return on investment. Selling below copay essentially trumps all other value proposals that may try to compete with HIMSS. And together with management's ability to pick profitable new healthcare verticals, the combination of these two factors is likely to have HIMSS printing much more free cash flow than at present in a year's time or so. And indeed over the coming 5 years, because that is the shortest my investment time horizons get. Indeed, at present, I'd argue that the free cash flow growth that you saw in the previous graph is the result of no other player in the US healthcare market solving the acute pain in question as effectively, conveniently, price effectively as HIMSS is doing at present. Over the long term, should HIMSS continue to execute this algorithm correctly, the number of verticals on the platform will increase exponentially and will eventually attain a critical mass beyond which it won't make sense for customers to get their healthcare services on a different platform, like is the case with Amazon at present, or with Costco shoppers, or with Spotify listeners. Once this tipping point is reached, I believe that HIMSS will go on to be one of the largest healthcare players in the US. Naturally, there is no certainty that this will happen. I only have 5 positions on my portfolio, but because most of them, the other 4 are multi-baggers, I can afford to run this risk. But essentially, I continue to be long this platform because they're beautifully executing the algorithm. They're solving a growing volume of acute customer pains in a way that's increasingly harder to imitate profitably. Indeed, all factors point to a company that's likely to get much larger from here. Operating in a $4 trillion industry, and by the way, I don't think HIMSS will limit itself to just selling pills. I think they will go on to do other things in the healthcare industry. At a market cap of just $4.28 billion, the company has a huge runway ahead. In my view, a $400 billion market cap from here is just a matter of HIMSS executing its current algorithm over a long period of time. Additionally, I believe that the most valuable component of this business long term will be the AI models that they will be able to train via their closed AI loop, which I've talked about many times in the past on X. Essentially, no other healthcare player has a database which correlates patient treatments to patient outcomes longitudinally, so over time. HIMSS is therefore able to see how certain treatments work with certain cohorts of patients and then optimize that over time. The AI model they're going to be able to train with that data can become over time their most prominent source of revenue. That's a little prediction I'll leave you out with today. I hope that you enjoyed the video. If you enjoyed it, can I please ask you one favor? If you could please share this with one friend whom you think will enjoy it, I'd be super grateful. These deep dives are for free, and so the only way this grows is with your help. By the way, if you want to learn more about the blueprint that makes these businesses successful and that led me to making an investment in HIMSS at $15, or Palantir at $7, or Spotify at $97.50, or AMD at $4.2, or Tesla back in 2016 at something like between $13 to $14, check out my tech stock goldmine course, in which I break down everything I've learned over the past decade in making those investments. The course also includes the lessons that I've derived from making mistakes, which I've written about in the past, which you can go check out in the blog and so forth. It sells for just $250, but if you pay attention, you will catch a discount here and there. I like to make the course available to my prospective customers, and of course, I guarantee the highest levels of satisfaction. If you don't like it, I have a 14-day money-back guarantee, so hit me up if you don't like it, and otherwise, please enjoy. See you next time. Take care.